Hi everybody, welcome back to the 10th of an Hour with Griffin Bridgers. For today's episode, episode 107, we're going to dig into the filing requirements for the gift tax return, IRS Form 709, and seek to answer the question, when must I file a gift tax return? Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, gift tax return filing is a tricky proposition because it's extremely rare that gift tax is ever paid out of pocket. Now, the filing requirement still may require you to file even if no tax is paid out of pocket. And there's a hierarchy to determine that, and these are some of the issues we're going to look at, but you usually look at gifts on a calendar year basis by an individual. And then you dig into some exclusions. One is the gift tax annual exclusion, which applies to each donee receiving a present interest and excludes the first $15,000 of present interest gifts to that donee for gift tax purposes. Further, without even looking to the annual exclusion, direct payments of medical and tuition expenses will not be reportable gifts and won't even dig into that annual exclusion. Now, gifts of future interest and any gifts of present interest in excess of the annual exclusion could generate gift tax, but they're first offset by a marital and/or charitable deduction, subject to certain rules we've looked at in the past and we'll look at further in the future. Now, it's important to note that for the terminology, once you take out all annual exclusions and the marital and charitable deductions and an offset for gift splitting, as we're going to look at later, what you're left with is a figure known as taxable gifts. Now, only your taxable gifts generate gift tax, and the gift tax is offset by the gift tax applicable credit, which is a tax credit equivalent to lifetime gifts of $11.58 million, which is the applicable exclusion amount for gift and estate taxes. Now, we're going to dig into when you have to file over the next couple of slides, but if you have to file, your due date will be April 15th plus extensions. Now, if you die during the calendar year, and if your estate tax return due date is earlier than April 15th of the year in which you're reporting gifts, then you'd have to file by the estate tax return due date. Now, I mentioned extensions, and if you file an income tax return extension, that automatically applies to your gift tax return as well. But technically, it only extends the gift tax return to the due date of the income tax return. So, if you're going to file the income tax return, you have to file your gift tax return concurrently or before the income tax return is filed. It's usually good practice to file them together if you don't have independent extensions. Otherwise, you can do a separate extension for the gift tax return if you want to have separate filing dates. Now, in order to really kind of answer this question, it's important to look at situations where no gift tax return is required, and by corollary, we're going to look at where it's required or preferred on the next slide. So usually gifts to a spouse that are eligible for the marital deduction won't require a gift tax return. Now, we can carve out a couple things. If you're going to make a Q-tip election for a transfer and trust, you must file the gift tax return. If you're making any split interest gifts with a non-charitable interest given to the spouse, you also have to file. And then next, if you're making gifts to a spouse that don't qualify for the marital deduction, these are known as non-deductible terminable interests, you would have to file then as well. Next, we have present interest gifts that are below the gift tax annual exclusion for each donee and/or are direct payments of medical and tuition expenses. If all of your gifts meet that category as well, you don't have to file, as long as there are no gifts of future interest made during the year. And then finally, if you have no intent, on your end, this is more of a preferential thing. If there's no intent to make the gift splitting election or to elect out of an automatic GST exemption allocation, then you don't have to file either. And the GST exemption will just be automatically applied to any transfers made during the year as well. Now, As a corollary, your required or preferred gift tax filings will be any gift to a spouse not qualifying for the marital deduction and which exceeds the gift tax annual exclusion, and also any gift of a future interest as well. Then looking to all non-spousal donees, you'd also take into account if you have any gifts of present interest that exceed the gift tax annual exclusion, and that would include a situation where maybe you superfund a 529 plan to use a 5-year averaging of your gift tax annual exclusion as well. And I didn't mention that on this slide, but there's another requirement where if you're making a split interest gift to a trust such as a charitable remainder trust or a charitable lead trust or a pooled income fund, you'd also have to file a gift tax return. And then finally, we have some elective types of gift tax return filing requirements. One might be where you wish to elect out of automatic GST allocation, whether or not you're going to manually allocate it, or where you want to make an election to treat an estate tax inclusion period trust as a GST trust. So if the trust was going to be included in somebody's gross estate, which would otherwise prevent you from allocating GST exemption, you could elect to treat it as a GST trust, which would allow for allocation now or in future years. Now, if you're going to gift split with a spouse, you have to file, and this is kind of a recommendation for any non-cash gift, even if you wouldn't have to file anyway. If you wish to start the 3-year IRS limitations period running with respect to the valuation of that non-cash gift, it's preferred that you file then as well. Now, gift splitting is a discussion that warrants its own separate episode, but we'll dive into the basics here in case this is a new concept being introduced. But generally, if the non-donor spouse signs the donor spouse's gift tax return consenting to the gift splitting election, this is about as close to a joint gift tax return as you can get. Now, usually gift tax returns are done on an individual basis and not a joint basis, but with the gift splitting election, you kind of come close to getting there with some nuances. Now, the effect is that with the gift splitting election, no matter who the actual donor is on paper, that means that all non-spousal gifts for the year will be treated as being made 50-50 by each spouse when it comes to the use of exclusions and applicable credit and so on and so forth. Now, for gifts of spousal joint assets, usually as community property or joint tenancy property or tenants by the entirety property, those would be treated as being sourced 50-50 anyway. So a gift from that type of property wouldn't require a gift splitting election, but both the spouses must consent not on the gift tax return, but on the transfer documents to transfer any community property or tenants by the entirety property. They wouldn't need to consent for joint tenancy under most state laws. And then finally, if you have any split gifts that are future interests or which exceed the gift tax annual exclusion combined among the spouses as to any donee, then both spouses would have to file their own gift tax returns, and each would have to cross consent to gift splitting on each other's gift tax return. So lots of nuances there. That warrants its own discussion, and there's a number of other issues that we've left open in our talk today that warrant their own discussions as well. But due to the sake of time, we'll have to punt those to another episode. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of the 10th of an Hour, and I look forward to seeing you in the next one.